Let's get across what's going on in the property sector. Anthony Landahl joining us from Equilibria Finance. Anthony, good to catch up with you again.
Nice to be here.
Yeah, so it has defied predictions, hasn't it? We were seeing in some capital cities, those prices are now at a record again.
Yeah, we've seen, I think most economists were looking at a drop in the market over the last 12 months, but we're seeing what's now been tagged a V-shaped recovery where from the highs of April 22, which you intimated, the market nationally dropped 7.5% in 9 months. Then we have seen a recovery essentially from February of this year through to November over the last 10 months of 8.3% nationally. So we're above in some states those highs of 2022 again. That's now been driven by Perth, Adelaide and Brisbane. Sydney's rate of growth has slowed and we're actually seeing negative growth in Melbourne, Hobart and Darwin. So it's a diverse set of numbers, but the market is back above those April 2022 levels nationally.
Yeah, forecasts next year we might be seeing growth of around 4 to 6%. However, that's not a consensus view. But just taking a look at what has happened to this point, what has been driving that growth? Is it all about that immigration rate, putting pressure on supply?
I think we've got to take it. Look at the basics of supply and demand. I think it's a confluence of factors. There's some mixed views around how much the migration numbers have in fact influenced the demand numbers, but I think you have to look at the fact we've had net migration of around 500,000. So a lot of those migrants, whether they're looking for a new house or they're driving some of the pressure on the rental market, that's definitely having an influence on the market. We're also seeing from a demand side, the other couple of factors are the number of people per household is falling. So more people are looking for a place to live, and people are finding that some of the renters are now going, look, maybe it starts making sense to look for a property. On the supply side, whilst listings have grown a little bit over the last month or two, we're down on the 5-year trends. Total listings are down on last year's numbers. So we're seeing less stock, and we're also seeing from a supply side, dwelling approvals are down. The federal government talked about getting 240,000 dwellings built. Next year we got 170,000 dwellings in the pipeline. The following year, about 155. So dwelling approvals are actually falling whilst migrant numbers are up. So it's really just a supply and demand mismatch has kept the housing market on that recovery trajectory.
Yeah, there was some recent data indicating perhaps it is, in some areas at least in the country, cheaper to buy than it is to rent, given where those rents have gone. And that's despite that rapid rise in interest rates we're seeing, still servicing your debt, that it may be cheaper to buy, but of course you've got to come up with a deposit first, haven't you? And that's getting larger and larger. So just in terms of those credit flows, what are we seeing first off in the owner-occupier space? Yeah,
good question. Just on that deposit, from a housing affordability perspective, it now takes 10 years to build a 20% deposit. About 10 or 15 years ago, it was 5 years. So that is a big challenge.
Amazing,
but
isn't it?
In terms of our credit flows, so the main thing driving behaviours over the last 12 months, from an owner-occupier perspective, for new buyers, it's been adjusting to the fact that their ability to purchase or their purchasing capacity is down about 30 to 40%, and getting a deposit is a challenge. But credit flows, they're down around about 8.3% on the last 12 months. First home buyers is only down about 3%. So they've adjusted and they're coming back into the market. The big areas we've seen the drop off are new dwelling approvals. Credit flows for new dwelling approvals, we talk about supply shortage, they're down close to 30% still on last year. So we've really seen struggles with the supply chain issues, material costs and a tight labour market really influencing those dwelling approvals flowing onto credit. The other area is investors. Existing investors are struggling to hold their properties for cash flow. We're seeing investor listings up in most areas as compared to historic trends. And we're also seeing investor credit flows. They were down about 30%. They're starting to trickle back now.
Are those investors on the whole selling at a loss?
If we look at where investors tend to buy, they're looking at capturing that capital gain. We're mainly seeing investors selling for cash flow reasons. Tacit numbers, or what we're seeing within our client base or what we're hearing, we're not really seeing investors selling at a loss. In fact, we've got an example recently of an investor taking advantage of the rising market in Brisbane and saying, hey, we're back getting some capital growth. We just can't hold on to this property for cash flow reasons because interest rates, costs of maintenance are outrunning the strong rental yield. So it's more the cash flow challenge for existing investors. For new investors, its cost to get into the market's gone up, but actually finding those investable properties is a challenge with low stock.
Let's assume that interest rates have peaked. What's that going to do for the investor market then, do you think?
Yeah, look, I think the investor market, we are seeing investors start to trickle back. A big challenge for the investors is finding those properties that meet what they're looking for: capital growth, strong yields, and ultimately a long-term strategy that fits. So I think for investors, it'll help them come back into the market, but we won't see we're still going to see those cash flow challenges. I can't see investors racing back into the market in the short term. There's also uncertainty around some government policies. We've seen in Victoria a lot of government policies impacting investors with land tax expansions, Airbnb taxes. At one point, to the end of the September quarter, investor listings were 60% of the Victorian listings. So I still think we're going to see a trend where investors are going to be pretty cautious, irrespective of where the rates go.